Hey, good morning, everybody, and welcome back to this week's Multifamily Unplugged. Glad you're here. Hope you're having a great weekend. And if you're new to the show, hey, I appreciate you being here. And obviously, somebody who cared about you in your life told you about us and told you when we're going to air and when we're going to be on. So I'm grateful to them and glad you're here. And if you are somebody who thinks somebody should be here, make sure to pass this link on to them. Thank you. This morning, I'm excited about our guest. But before we get into our guest this morning, what are you working on this weekend? I have been doing a lot of things, around multifamily and business. But it's easy for us to get distracted, right? And it's easy for us when the market cycles like it is right now to maybe get shiny object syndrome and look at something else. Maybe bounce from asset class to asset class because we think something's going to be easier. Here's what I know right now, though, that we are entering one of the best times in history to ever buy multifamily real estate and real estate in general, actually. And as we start to cycle out of this market that we're in right now and start to come back out, you're going to start to see profits increase. You're going to start to see occupancy increase, rents increase. You're going to see more demand for what you're doing. And you're going to actually see the profitability of your assets starting to increase, some by your own efforts and some just by what's going to be happening in the economy around us. So right now, what I'm talking to people about is being very intentional and specific about what they're doing in their business. Hey, if you need to learn to underwrite a little bit more, then let's figure out what that's going to entail. If you need to learn how to raise capital more proficiently, then let's talk about raising capital a little bit more proficiently. But let's get you that education, that knowledge that you actually need. Teach you how to build great teams and partnerships. And, what we try to do by bringing content out to the marketplace continually like this is help you grow, help you do that. So today's guest is going to, really add to the flavor of that and give you a little bit more of that. But before I get started, remember that coming up in October is our 6th annual Multifamily Summit, this virtual 2-day event. October 16th and 17th, 20 speakers and panelists from around the country, some big headliners this year. We're going to have Hunter Thompson on. We're going to have Brad Sumerick on, Michael Guthrie, Forrest Corral, some people that have done billions of dollars, billions with a B, in multifamily investing. A lot of opportunity to learn, get ignited, grow your business, and take advantage of what's coming up in front of us here. So get your ticket for that event, get registered. Seats are filling up fast. Go to multifamily25, that's multifamily25.com. Get your ticket, and we'll look forward to seeing you at this year's event. And listen, if you upgrade to the VIP seat, you're going to be able to participate in some offline events that are going to benefit you the evening before and time around the event. So looking forward to seeing everybody at the event this year. Hey, my guest this morning, Hector Garcia. Hector's with Passive Partners. They're a hotel conversion company, and I am super interested in this. I heard Hector speak at a meetup that I host in Vegas just a few weeks ago, and we had talked after that and decided, hey, this would be a great platform to have Hector on to talk about a strategy that he uses in making multifamily come back alive again. Remember, we're buying businesses here that are in many cases broken that we're trying to add value to, and this is one way of doing it. So let's bring Hector back in. Hector, good morning.
Good morning, Mike. Pleasure to be here. Thanks for having me.
Great to see you again. How's it going?
It's great. Thank you.
Good. I know you're right here in Southern California, aren't you?
Yes. I'm Mexican. My parents, both, grew up in Mexico. They brought me here when I was 3 years old. But I grew up in Orange County, Southern California, pretty much my whole life. So I'm a local to California.
That's awesome. Awesome. And listen, we won't hold the Mexican thing against you at all because my best friend in the world is Mexican, and he always makes jokes about that. And it's a lot of fun. So plenty of time.
Don't worry.
Yeah. It's awesome. Hey, listen, before we get going here, one question I always ask my guests, and I'm going to write a book on this, right? And I'm going to call it the one word. But in one word, what best describes you personally and professionally?
Good question. Top of mind, I would say partner, because I'm a partner to a lot of people, and they rely on me to grow their network, grow their cash flow. And I consider them, essential partners in my deals as well. Even though they're limited partners, they're still my partners. So, I really pride myself in being a good operator and a good partner to them. So I would use the word partner.
That's awesome. I love that because, I think we need to treat the people around us as partners, whether they're somebody who is a tenant, an investor, the partners that are designated as partners, right? And then, there's those ancillary partners that we have. We've got vendors, we've got contractors, we've got subcontractors, all of those people. I just think that, the employee-employer relationship is really, kind of non-existent in what we do. And for us to be able to say that this person who helps grow my business is really my business partner, because, hey, it goes back to what Zig Ziglar said years ago, which is if you help enough other people get what they want, you'll ultimately get what you want. And that's really a partnership concept,
Absolutely.
So tell people a little bit about yourself, what you do, what your background is, and how you got into this hotel conversion business.
Yeah, well, I've been, in real estate, investing in real estate since a young age. I purchased my first property at 17. I'm now 37, so that was 2 decades ago. But it was always in the single family space, land development, entitlement, condo flipping, just, a lot of little smaller deals all along my 20s and early 30s. But up until I finally started to really deep dive into commercial real estate, which was around COVID time, that's when I really focused pretty much all my energy into multifamily. And that's what led me to purchase my first multifamily property, previously to not having any partners. So this was all my own money. And I purchased a 20-unit apartment deal in San Bernardino, California. That was my first deal that I ever did in the commercial world, in the multifamily space.
Well, let's talk about that deal. I love that. It's a 20 unit, right? And a lot of people, come into business and they think, oh, I can only do a 4-unit, or I can, I have to have hundreds of thousands of dollars and go do a 200-unit deal. But your first unit was a 20 unit. So what, tell us a little bit about that property and how you purchased it, and, what you did to that. Was that a conversion project, or was it just a standard buy and hold?
Originally, it was going to be a buy and hold. I was looking for equity upside previously to purchasing that. And I want to just reiterate, it's very important for anybody going into multifamily space to first educate themselves. So I really dove really deep into multifamily, understood what cap rates, NOI, forced appreciation, what all that meant. And that's what led me to find this property. And it checked off all my boxes. And it was going to be a buy and hold. The only box I did not check out, which I didn't even vet, was a neighborhood. So it turned out to be a war zone, very bad neighborhood. And that's the reason why I ended up selling it. So lesson learned, you got to also check out the neighborhood, not just, rent upside, equity upside, cash flow. That was all beautiful on paper. But up until I was head over heels on the property, I realized it wasn't a bad neighborhood. I ended up selling the property 18 months later. But it was a really great lesson. I could explain on why I purchased it and what the upside was on the deal, if you'd like me to.
Yeah, let's talk about that deal. Go ahead. I want to hear more about it. I know my listeners do as well.
Yeah, sure. When I purchased it, it was right in the middle of COVID. So as you know, in California, we have that rent moratorium. Half of the building wasn't paying rent. So I knew that from the start. I also knew that.
Let me ask you a question. So when you bought it, did you get a discount because people weren't paying rent and the NOI was lower?
Yes and no. I paid based on a price per unit, knowing that the price per unit in the neighborhood was a lot higher, and the cap rates were still pretty decent because the rates were still pretty low at that time. So in paper, numbers wise, it was a great deal, but it had a lot of hair. Half the people weren't paying weren't paying rent. The building was in distress. It was in a bad neighborhood. So there were some negatives to it, but that was my sweat equity going in to try and fix and remedy all those problems.
And so let me ask you this. Let's talk about the financing piece of that. How much per unit?
It was 72,000. It was $1,450,000.
Okay.
For 20, which was around, I think it was like a little over 70,000 a door.
Okay, great. So we know on $1.4 million, you generally have to come to the table with 25-30% down just on the acquisition, not including any construction. So you're going to finance, call it 65-70% LTV. But in order to do that, you usually have to have a DSCR of 1.25. Did this property have a have a DSCR of that?
No, it was actually negative. So you couldn't purchase this property with traditional financing, a DSCR loan, a loan. So we had to go a bridge loan, basically a hard money loan. So the rate was high. It was, I think, 9% at the time. But I came in with only 20%. Was with closing costs and everything, it was around 300,000 that I had to put down. So that was my first deal. 300 grand down, no cash flow. Half the tenants weren't paying rent. But my numbers, and based on my education that I pretty much self-taught myself, I realized that I had some upside and I needed to clean up the property. And the way I did it was day one, I closed on the property, and all the people that weren't paying any rent, I went in there, knocked on their door, and I offered them cash to leave, knowing that the moratorium was going to expire in the next couple of weeks. And I told everybody, hey, you're not paying any rent. You're going to get evicted. But if you leave this week, I'll give you $5,000. And they all took it, knowing that they were going to get evicted regardless. But as you know, in California, that moratorium got extended like 2 or 3 more times. So I got really lucky that these tenants actually left, or else I would have been stuck with them for, another year or so. But that was a big win. Immediately after closing, I got the tenants out. I proceeded to do the renovations. Once the renovations were complete, new tenants were moving in, and the rents had doubled. So going from $700 to $1,150, $1,200 was the rent that I finally achieved once the building was stabilized. So 18 months later, fast forward, I sold that building for $2.8 million, which was double our purchase price from 18 months ago. Netted a little over $1 million, or just shy of $1 million on that first deal. So that for me was a big aha moment that everything worked out and the numbers really penciled out from the beginning, and I was able to execute the business plan. But it was the first deal. I learned a lot, made a lot of mistakes. I could have easily lost my shirt on that first deal, but thank goodness it didn't, and it went well, and proceeded to do more just like it. So I was practically known as the cash for key guys with a lot of brokers. So they were just sending me their deals, knowing that these kind of properties had some upside, but I needed to go in there and do the dirty work and vacating the buildings with the low rents.
So let me ask you this. So I just want to be clear with the listeners, right? That in that capital stack for financing, you did a bridge loan, which a bridge loan will generally cause you to have a higher interest rate. But then you were able to go back, get the rents up, get occupancy up, go in and refinance, put perm debt on there, and get a lower interest rate.
That would have been the goal because I wanted to hold it. But remember, I bought it in a bad neighborhood. So after knowing that I bought it in a bad neighborhood, I just decided to sell. So before my 2-year bridge loan was up, by month 18, I had already sold it, paid off the loan, made $1 million on it, and I just moved on.
So you didn't know it was in a bad neighborhood when you bought it. So it sounds like maybe you didn't run the market traps and do the research on the neighborhood, huh?
Again, remember, I would just focus on the numbers. The numbers seemed great. Based on what I had learned, I could increase the NOI from X to X, creating massive value. And that was all I focused on. Once I purchased the property, first week of ownership, I go look at the property, do a walkthrough, and there's SWAT in every single corner of the building with hands, with guns pointing at a unit. And they were raiding the unit for drug trafficking. So that was my first week of ownership. So, and that was consistent throughout the entire process that I owned it. So yeah, drugs, trafficking, prostitution, you name it. It was a war zone. But regardless, I still made $1 million in a war zone. So the business plan is solid. You can still make a lot of money here in California, and I've been consistent with it. So
that's awesome. Now you said you gave all those tenants $5,000 cash for keys. Did you underwrite that cash for keys number into your underwriting before purchase?
Yes, I did. So yeah, so I underwrote the cash for keys. I budgeted for cash for keys and then the renovation costs for the entire building. So total renovations was just under, I think it was like $300,000 that I spent in renovations, and then cash for keys, 5 times 20, so about $100,000 in cash for keys. So all in all, about $400,000 went into the property to go from 1.4 to 2.8. So minus commissions, minus costs, it was about $1 million profit.
So I want the listeners to listen into this morning, because this is really good stuff. And a lot of times people don't think about this, right? But hey, you're going to buy a broken business, a broken building, right? And you're going to go in and rehab it, refix it, re-engineer it, right? And this is exactly what you did. You re-engineered this building. And so you've got to put those anomalies into your underwriting. You have to know going in the door, hey, I have this much money in an envelope, over here that I'm going to use for cash for keys. And if I don't use the money, great. I use it somewhere else in the deal or get to keep it. But if I underwrite it in there, then I know exactly what my return is going to be on the way out. Did you know prior to your exit that you were going to make $1 million on that acquisition?
Based on the numbers that I had underwrote, I knew that it was going to be about a $3 million deal once I was said and done, if I were to bring the rents back to market, or at least to market where they needed to be. And it actually did get appraised for $3 million. The buyer that purchased my property did have an appraisal for $3 million. But after back and forth and some negotiations, I let it go for 2.8, and then I was still happy to sell it for 2.8. But yeah, I hit it right on the bullseye on what my numbers were prior to me purchasing the property. And this goes back to, again, really educating yourself in commercial real estate, really educating yourself in multifamily, knowing your numbers, learning how to underwrite. And if you know how to underwrite, the deal will pop out of you when you see it. So most people will go on LoopNet or call brokers, and they don't really know what they're looking at. But once you know your numbers, specifically in your geographic area, you know that you can create value, and those deals will literally pop out in front of you. And that's what happened to me. So I was looking for a deal with upside. And when I finally saw it and found it, I underwrote it quickly, and it was spot on to what I thought I could get it to. That's
awesome. Hey, let me ask this. For $300,000 in renovation dollars, what did you do to those units and to the exterior of the building?
Sure. Exterior was paint. I did some little bit of roof work. I did do windows. Interior, we did all new vinyl floors, some kitchen cabinets on some of them, new countertops, and LED lighting throughout. And a couple of more little things here and there. We did a new boiler. I do remember that. And overall, I actually budgeted more for the renovations, and I came under budget around $300,000 for total renovations.
And did you watch everything along the way? Were you very price conscious when you went to buy flooring or paint or lighting fixtures?
Yeah, so I'm very hands-on. Even today, now that we're doing hotel acquisitions and doing the same project but on 100 units, I'm still very hands-on. I'm dealing with the GC on a weekly basis. And then at the property, the GC is not there, but they have their subs there, and I'm dealing with the subs, making sure they're doing work the right way as well. So I'm very hands-on, very price conscious, and I think that's one of my strong suits, that I'm very active in the deal, not just in the beginning when we're doing acquisition, but all throughout the renovation process as well. And I think that's very key to have a good partner that could do that. And I pride myself in being local and having all my deals here in Southern California, because I could get to any property that I own within an hour and a half tops. Be there, do my work, make sure stuff's getting done, and then be home by noon, which I really, really enjoy.
That's awesome. So you took rents from $600 to $1,100. What did you have to do in that renovation to really make that unit pop? What was that extra that tenants went in and you really gave them the wow factor of a new experience that they were going to have in this building in the ghetto?
Yeah, good way of putting it. Because they were new, and the tenants that live in the neighborhood, they're not used to walking into newly renovated units with new flooring, new cabinets, countertops. They're just not used to it. So, and we're priced at where the market is, if not, a little bit lower, to quickly fill them. So for the units got absorbed super quickly, to answer your question. So it was a nice new product for the neighborhood. Again, I didn't vet the neighborhood. So although they were new, beautiful, the people that were moving in, it's the same people that we have vacated previously. Not the exact same people, but I'm saying the same demographic of people were moving in. So fast forward, I'm pretty sure the building is in rough shape now, and it looks about the same from when I bought it, 5-6 years ago, which I'm glad we left that neighborhood. But regardless, would I do it again? Absolutely, because the numbers make sense. I know we could do it, and it's a value add business plan that if you could get in, just get out. And that was my business plan. Moving forward after the next couple ones that we did, is I knew that I wasn't going to hold these. I was just going to come in, do my work, increase value, and then hand it over to the next guy that actually wants to operate in the neighborhood. For me, that's not me. I created value, and I saw where my expertise were more valued.
So I have a couple of questions around this. This is a very interesting deal. And I think that the thesis behind what you're doing by this type of opportunity, in and out, a flip basically in the multifamily space. How many deals are out there in the marketplace like that? And are they only in California, or where else might they be?
They're all over the country, really. You could, if you look for multifamily, get your foot in the door with the brokers and let them know what you're looking for. I'm sure you could take them out. One thing is, I learned, some tricks with the cash for keys, and I know some, how to get to these tenants to make them realize they need to vacate. But it's not 100% bulletproof strategy. So although I was very successful with that first deal, fast forward, 2 years later, I bought a small 8-unit apartment deal in Los Angeles, where same business plan, the rents were super low. They were $700-800. The market rent for these 2 bedrooms, they were all 2 bedrooms, was around $2,500 for rent. So I knew I was going to have a huge win with this 8-unit apartment deal. After I purchased it, I proceeded to do my normal cash for keys, and not one tenant moved out. Not one tenant accepted the offer. Later, I realized that every single tenant in there was a family member, that every time there was a vacancy, they would bring in a new family member and a new family member. So over 20 years, they had created a compound of 8 units comprised of all family. I didn't feel right vacating the tenants, and I knew why they weren't going to take the offer. So that's when I said, cash for keys works great. You can make a lot of money up until you can't, if you can't vacate, you have no business plan. I have no value upside. Ended up selling the property for the same amount that I bought it for. But that was a big aha moment for me, that I could only do this up until I get caught. And this one, really was a big eye opener for me. So that's what transitioned me to only look at buildings that were either one vacant or basically just units that I knew I could turn right away. And believe it or not, in Southern California, a vacant multifamily deal would sell for higher than a fully occupied multifamily deal with tenants in it. Because the sellers and the brokers know that as soon as you take over, you do your renovations and your rent goes to market, you're going to create massive value. So a vacant apartment deal in anywhere in Orange County, Los Angeles will sell higher than a fully occupied value add deal. And those are pretty hard to come by, but they are out there. And because they were hard to come by.
Which ones are hard to come by?
The vacant buildings, the vacant multifamily.
Okay.
Yeah. So they're out there, but the brokers, they sell them very quickly. And that's what transitioned me to look at the hotels. Because hotel market, I could purchase the property. I already know what my price per unit is day one. And I also know that day one, I have no vacants that I have to vacate. I have to pay cash for keys. So that budget that I always put to the side for cash for keys, it doesn't exist in the hotels. I know that the day we close, we're going to have a vacant building that we can immediately go in, do our renovations. And we already know ahead of time what those rents are going to be for these studio units that we're going to be transitioning from hotel to multifamily. So that's where the big aha moment and the focus went from looking at vacant multifamily, doing cash for keys, to now purchasing these motels in good locations and with great rental upside. So
and we talked a little bit about that. So, the hotels you buy, they're not the old style exterior doorway hotels. They're interior hallways with interior entrances. So you're doing a really upper scale conversion from the old hotels to this new multifamily product?
Yes, correct. So we don't look at the motels, we look at the hotels with interior corridors. And once these apartment or hotels to multifamily are converted, they'll show just as nice as an A-class right down the street that's getting top rent, but we're going to be slightly below to account for the size of the units. So every hotel room is roughly around 250 to 300 square feet, give or take. And those are the size of our units. So it's just enough space for a single or a couple to go in there. They'll have their own kitchenette, their own full-size refrigerator, not a mini fridge anymore. And they'll have a nice, clean, comfortable place in a good location in Orange County, not very far, next to Disneyland, where we know the rents are very high. So just to give you an example, for these units, we'll be averaging around $2,300 per unit for a studio apartment in Orange County. And we're buying these hotel rooms for $125,000 a door. Our appraisal by CBRE is showing that we're going to be around the $26 million mark once it's done. We're buying it for 13. We're 26 once it's done as a conversion. So it's huge, huge upside for us and all our partners involved.
All studio units.
All studio, correct. If this were,
do you ever get concerned about occupancy with having all studio and not having any 2 bedrooms or even 1 bedroom units?
At first I did, but here in the local Southern California market, they average about 97% occupancy, even for small studio apartments. And the reason why is Southern California, very expensive place to live. Rents are extremely high. If you wanted to rent a 2-bedroom down the street, you're going to pay closer to $3,000. So for us to be at $2,300, they're considered affordable housing for the area. So because they're affordable, even though they're smaller, the occupancy stays pretty consistent across the board.
So could you take these and maybe combine 2 units together and create a 600 square foot 1-bedroom? Would that give you any more rent? Would that hurt the occupancy? How would that work?
We won't do it. And very simple economics. If we combine 2 units into one for basic math, let's just say we get $2,000 for 1 unit. So there's $4,000 if we have 2 units. But if we combine 2 into 1, the max we could probably get is around 3,000. So it would make more sense to keep them separate, keep smaller units, and get higher gross rents by having multiple or more single units. So the one we're purchasing now, it's 104 units. We're not combining any units. We're keeping them all the same size, and we already know where our rents are going to be. So that was the question that the city asked as well. We're not going to combine any units.
And are you developing a luxury product?
I would say like class B, because it's not in an A class neighborhood. It's more of a B, but it's going to be really nice, comparable to luxury for sure. So because we're putting all new vinyl plank floors, brand new, white shaker cabinets, quartz countertops, some really nice stainless steel appliances. So same amenities and luxury that you will have in an A class building down the street, but for much lesser rent, more affordable.
Got it. Beautiful. Well, listen, this has been fascinating. I appreciate you taking the time out of your busy schedule to be here this morning. Any last thoughts that you'd give, a new investor?
Education starts with education. And if you really don't have the time to, spend hours of education, but you want to get your foot in the door, the easiest and fastest way to learn the business is being a partner, investing in somebody else's deal. I know you do a lot of multifamily as well. So I think being an LP investor in some of the deals that we do, you really get to peek behind the curtain on how these deals get done, how they get structured, how do you create value. And I think that's the quickest and fastest way to really learn the business and see if you want to really do this on your own in the future. So my word of advice is, just become an LP investor in somebody's deal. It doesn't have to be my deal, your deal, but look for a good operator that you trust, and just partner with them. But get your foot in the door that way.
Yeah, that's awesome. Well, listen, I appreciate you being here. I know you do a little bit of capital raising, and you're looking for partners to come in and participate with you. Why don't you tell people how they get a hold of you?
You know what? The easiest way and fastest way, just call me on my cell. It's not going to go to an AI or an assistant. It's 951-216-9730. I'm always active. So if I don't get a ring, just send me a text message. I'm very good at returning calls and messages. So
awesome.
Cell phone's the fastest way. And then I'll give you my, contact email and website for your listeners as well. You can put that on the show notes. Yeah,
we'll put that in the show notes. And, people want to reach out to you, they definitely can. Hey, I appreciate you being here this morning. I'm going to move you back to the back room. I'm going to say goodbye to the audience, and then let's spend a few minutes together. All right.
Let's do that. Thank you.
Thanks again. Bye-bye. Hey, everybody. What a great episode, man. I'll tell you what, I've been in the business a long time, 30 years, right? Done residential, done construction, multifamily. And I picked up a couple things this morning. I'll tell you, for me, the biggest golden nugget was to underwrite into your underwriting the $5,000 per unit cash for keys. And, that's a big thing, because you always wonder, well, where would that money come from, right? For that ancillary thing. But here's the big thing he said, for an investor, go get the education that you need to get. Go get educated and learn what you need to learn. And I think that was just a phenomenal comment. And, you may or may not be aware, I have a coaching program. I teach people. I have a mentorship program. I actually have a partnership program where I partner with people. If you're somebody who's looking for getting in the business, for understanding the fundamentals and the systems that will help you scale your business, you know what? Reach out to me. Even let's just have a conversation. Even if I'm not the right coach for you, go get some education. How much would you spend on a college education, or did you spend on a college education? And so if you did already spend that money, what it costs to get educated. But if you didn't, and you could look at mentorship or coaching in the multifamily space as that college education that you need to get in order to go to the next level. Hey, I'm glad you're here. We're here every Saturday morning at 10 o'clock. If there's any questions you have, don't hesitate to reach out to me over the week. Be more than happy to answer those questions for you. Remember, the Multifamily Summit coming up. If you want to talk about a little bit of education, October 16th and 17th, please go and get your tickets. Seats are filling up fast. You can get to the website at multifamily25. That's multifamily25.com and buy your ticket there. Thanks, everybody. You have a